Welcome to Module 13 of the VITA-Train on tax extenders. This is a special module covering the new tax extenders as covered by Congress, and we'll talk a little bit more about tax extenders further on in the presentation. By the end of this module, you'll be able to prepare VITA returns that involve tax law issues that were changed by the Tax Extender and Disaster Relief Act of 2019. This includes tax law changes that affect Schedule A, tuition and fees deductions as an alternative to education credits, discharge of qualified principal residence indebtedness, and the residential energy credit. And this covers extenders that are both advanced and basic level certified. Let's talk a little bit more about tax extenders. What is an extender? Extenders are tax law items that have expired, and Congress has then decided to extend the law to cover more tax years. Laws that have expired but are expected to be extended are called extenders. Most of the tax law issues covered in this module expired December 31st, 2017. So they apply to tax year 2017, but not tax year 2018, and it will appear not to be covered in tax year 2019. But most were recently extended through December 31st, 2020. So these issues are now in effect for the tax years 2018 and 2019. What does that mean for you? That means all tax returns filed beginning January 27, 2020 can take advantage of the newly extended provisions. Not only that, but some taxpayers may benefit from amending their 2018 returns to take advantage of the extended tax benefits. But don't worry, most of these extenders will not affect the majority of VITA taxpayers. IRS Spec has wisely predicted that the extender situation and included detailed information about most of these items in publication 4012. Additional extender information and updates to the publication will be included in the forthcoming publication 4491X, and that'll cover most of the things you need to know. Taxpayers who can benefit from a 2018 amended return, that's a Form 1040X, have until April 15th, 2022 to file the amendment. So there's plenty of time and we don't need to go in a full-blown panic. Let's talk a little bit more about the Schedule A portion of the extenders. The deduction for PMI expense is back. So this means that taxpayers who itemize can take a deduction on Schedule A for the cost of private mortgage insurance premiums related to the taxpayer's income. The mortgage insurance premium is reported on Box 5 of the Form 1098, Mortgage Interest Statement. A taxpayer must itemize deductions to benefit from this deduction. The medical expense deduction threshold for tax year 2019 was set to be 10% of AGI. That has now been lowered back to 7.5% of AGI. While most extenders expired at the end of 2017, the 7.5% was in effect for tax year 2018. This means that this change will not generate amended returns for tax year 2018. Let's look at an example. Nick here broke his arm at a skate park last spring and had to pay $3,800 in medical bills that were not covered by his insurance. His AGI for tax year 2019 is $40,000. If you look at the old percentages, you still have the same amount of total medical expenses, which is $3,800. Then you look at the AGI threshold, which is $4,000 under the old 10%, but now is currently $3,000 under the 7.5% threshold, which means he gets an $800 medical deduction under the current plan. If Nick has sufficient itemized deductions, such as home mortgage insurance, real estate taxes, and charitable contributions, that exceed his standard deduction, he can increase his itemized deduction by $800. What about the tuitions and fees deduction? The tuition and fees deduction is covered in publication 4012, that's page extension 6. The gist of what you need to know is the IRS calls it the tuitions and fees deductions, but it's actually just an adjustment to income. It appears on line 21 of Schedule 1, Additional Income and Adjustments to Income. A taxpayer does not have to itemize deductions to claim this benefit. The adjustment is basically an alternative to education credits. A taxpayer's tuition and fees expense can be used to claim either an education credit or the tuition and fees deductions, not both. Like the education credits, a taxpayer does not qualify for the tuition and fees deductions if the taxpayer is using the married filing separately status. The adjustment is claimed on Form 8917, and the taxpayer is required to have Form 1098-T. And just like education credits, the information on the Form 1098-T may not be sufficient, and the preparer probably needs to see the student's account transcript. The education tax credit is already quite challenging. Adding the tuition and fees deduction makes it just a bit trickier because it is difficult to predict what is better for the taxpayer: an education credit or the tuitions and fees deduction. Here are some guidelines. If the taxpayer qualifies for the American Opportunity Credit, or AOC, that will almost always provide a better outcome than the tuition and fees deduction. That's mainly because for most taxpayers, part of the AOC is refundable. If they don't qualify for the AOC but can claim the lifetime learning credit, it is difficult to predict which provides more benefit. It's better to just try it both ways. But in some cases, the effects on state income tax returns must be considered. For some states, a reduction to federal AGI means a decreased state income tax liability. If this applies to your state, remember to review the effects on the state return. Let's talk about an example. Dan, age 28, has lived in Chicago all of 2019. He was a single, part-time graduate student, and he cannot be claimed as a dependent. His total income was $11,800 in wages, and he paid the following out-of-pocket education expenses. For tuitions and fees, he paid $1,200, and he paid $650 for textbooks. He remembers that his parents used to get a nice education credit when he was an undergrad, and he wants to know if he can get that on his 2019 return. He asked if he got it when he had his taxes done last year, and his parents said no. He wants to double check. What do we do about Dan? Since he's a part-time student and already has a degree, he will not qualify for the AOC. His standard deduction is $12,200, which wipes out all of his taxable income. So the lifetime learning credit won't do him any good. Since he has no taxable income, an adjustment won't help him either on his federal return. But Illinois in particular, their income tax is based on federal AGI. By claiming the tuition and fees deduction on his federal return, he reduces his AGI by $1,200. This decreases his Illinois income tax by $75. If his situation was similar for tax year 2018, he might benefit from amending his 2018 federal and state returns to claim the tuition and fees deduction on his federal return. But again, note that the effect on the tuition and fees deduction is not the same for all state returns. Please talk to your site coordinator to see how it works in your location. For more complete information, refer to Publication 970. Publication 970 for tax year 2019 has not yet been issued, but it will come out soon. So please, when in doubt, look it up. Let's talk about the discharge of qualified principal resident indebtedness. What does this mean? In general, canceled debt is taxable income, and the canceled debt is reported to the taxpayer on Form 1099-C. However, based on recent legislation, most taxpayers can exclude canceled debt on their principal return. Publication 4012 for tax year 2019 includes a lot of detailed information about this issue. See pages extension 1 through extension 5 on Publication 4012. Here's an insider tip. This process can be a little confusing. Discharge of qualified principal resident indebtedness is not an adjustment, deduction, or a credit. In fact, the canceled debt income does not even appear on the 1040. Form 982 reduction of tax due to discharge of indebtedness is prepared and filed with the return to explain why the canceled debt is not reported on the return. Let's talk a little bit more about the residential energy credit. The residential energy credit, also known as the non-business energy property credit, is back. It's covered in Publication 4012, page extension 7. The credit is non-refundable and it is claimed on Form 5695, residential energy credit. VITA sites may be asked about this, but few taxpayers actually do qualify. there is a $500 total combined credit limit for all tax years after 2005, meaning that a preparer may need to see copies of prior year returns. Most volunteers will never prepare a return with this credit. Let's recap. Other issues addressed by recent legislation may affect VITA returns. This includes the kiddie tax and the computation of EITC and child tax credit for taxpayers residing in certain disaster areas. At the time this module was written, insufficient information was available to address these issues. So watch the Tax Roundtable listserv, the Tax Prep Dispatch, and IRS VITA alerts for more information. But the good news is that this extended legislation will benefit VITA taxpayers. This includes more itemized deductions for medical expenses and the addition of the deduction for the mortgage interest premiums, an additional tax benefit related to education expenses, less taxable income due to special rules regarding discharge of qualified principal resident indebtedness, and a possible tax credit for certain energy-saving home improvements. The bad news is it just complicates tax preparation. But the great news is that VITA is made up of can-do folks who can do just about anything and adjust to it and make it work. And that's the end of this module. As we mentioned before, this is not fully up to date with all the stuff that may be extended through legislation, so keep your eye out on the Tax Roundtable listserv, Tax Prep Dispatches, and IRS VITA materials in order to stay up to date. And as always, thanks for volunteering with VITA and have a great tax filing season.